Where am I going to get the money to finance my house? Wait a minute, am I financing my house? I don't know. What type of loan am I using? I don't know. And wait, what language are you even speaking? She's a lender. In this episode of Give, Work, Play, we're going to talk about all the terminology, well, probably most of it, in what you might be hearing when you're buying a home from the lender's perspective. I'm Ginger Walker, the team lead of Give Back team of Coldwell Banker Elite. And today I'm joined by the beautiful Jessy Prince of USA Mortgage. And she's going to help us break it down as to what different types of loans there are and some of the basic terminology, or maybe some new interesting words that you might not have even heard before. So I'm an agent, and when I'm talking to a buyer, one of the things that we want to make sure is that they've spoken to a lender so that they understand what they can comfortably afford in a payment and what they can comfortably afford in a price range. So there's two different things that we will get sometimes. One is a pre-qualification or a pre-qual letter, and the other one is a pre-approval letter. What's the difference?
Pre-qual, pre-approval. They sometimes are used interchangeably, probably should not be used interchangeably. If you were to go and apply on my website and you state your income and state your assets and I pull your credit, I could issue a pre-qualification letter. Pre-qualification means that I've reviewed what you have provided to me. That is a great start. It gives us kind of a place to begin, but we like to elevate that to what's referred to as a pre-approval. And depending on the lending institution, some will refer to a pre-approval as being accomplished once they are in receipt of asset information, so bank statements, proof of your down payment, income information, and that they have run what is referred to as an automated underwriting system. A lot of lenders then kind of stop there and say, go shopping. There are lenders who do one step further. That's at 2.5 step of pre-approval, okay? And many don't do this because it requires additional resources from the company itself. We like to fully underwrite our clients before they go under contract, which means we're actually putting that before an underwriter. That is a full preliminary underwrite. So there are some differences there, and it's something to be aware of. But again, it goes back to knowledge is power, having a full game plan. I don't like surprises unless it's my birthday or my anniversary. So we try to keep those out of our loan files whenever possible.
I like that. So you mentioned another name, an underwriter. Mm-hmm. What is that?
They are our friends. They are our friends. We love them. They've gotten a bad rap, kind of like, a lot of other pieces of this story. The underwriter is basically your liaison between the house that you want to buy and your overall financial picture. And what they're doing is they are looking at the guidelines associated with the loan program, either issued by the investor, the federal government, or both. Sometimes there are extra rules in place. And the underwriter is saying, okay, do we have this piece of information? Check. Do we have that piece of information? Check. Does this information make sense in the context of this other piece of information? But they are here to help, especially if you have a team environment at your lending institution. They are really there to help strategize, or professional problem solvers sometimes, and financial strategists. So we like them.
That's awesome. Okay, so now we've got the letter, the lender letter,
yes,
and we're ready to run to go see houses. We get under contract. One of the critical pieces, though, before we offer the appraisal gap guarantee is actually having the conversation with the lender to make sure that we can offer that sum of money. So can you explain why?
Yeah. Cash. We need to make sure we have enough of it. Seems like maybe a simple concept, but as we're navigating these very competitive markets and we get emotionally invested into these homes, it's important that we're also taking a step back to make sure we can actually deliver on that which we are promising. So we want to make sure that maybe we do have the $10,000, but maybe it puts us in a pinch for some things we're planning for moving forward. That's why we work as a team as agents and lenders. So it's planning that matters, and it's kind of the same reason, same concept as why we don't go out and buy a truck in the middle of the loan process.
Wait, why can't I buy a truck during the middle of the loan process?
Great question. Once your loan is pre-approved, let's remember that it is based on your loan profile at the time that your application was submitted. This means not only your income, but any debts that you're obligated to pay. Your overall pre-approval, when we pre-approve you for a home, it's not actually for a purchase price. Did you know that?
I didn't know that.
What we're looking at is a maximum monthly mortgage payment as it relates to your gross monthly income.
Interesting.
Then there's another little factor that goes into that. So the other part of your debt profile is your housing payment plus all of the other debts you currently have to pay. So we have a really good understanding. Yes, Mr. or Mrs. Smith, you do in fact qualify for this. If you go out and buy a truck payment, a $1,000 truck payment can totally throw off your ability to qualify. Just because your loan application has been submitted and pre-approved does not mean that we're not revisiting this over the course of the loan.
So you're checking my finances all along the entire process.
We are. It is a pretty important process. I like to say we should remain financially quiet during the loan process.
Oh, I like that.
Yeah, just be cool. Be calm. Don't make any rash decisions. I like to say that once the keys are in your hand and the deed has been recorded, you're free to move about the cabin. Until then, I need you to remain buckled to avoid turbulence.
I love that. I think that's awesome. Let's actually talk about the difference between an appraisal and a home inspection, because they're not the same thing. And one of them may be required and the other one may not. The first thing I want to throw out there, because it is a contingency that possibly could be in the time frame of the contract, is an appraisal for the loan as well as a home inspection. The home inspection is not always something that is in the contract. It could be in the contract, but if you're borrowing money, is an appraisal always in a contract?
It may be, and so most likely yes. It depends again on the financial situation of the borrowers involved, and so I'll disclaim myself on that front because I'm a good lender and disclaiming is what we do. But an appraisal is basically a mechanism, an inspection created by an objective third party on behalf of two parties involved in the transaction, for the seller and for the lender. It's meant to protect both of us. So as a lender, we want to make sure that we are only lending in relation to a value that has been substantiated by the market. The appraiser is going to go out to the property and do a couple of things. One, they're going to make sure that the home itself meets the minimum required guidelines of the program. Certain programs might require more than others, but it's going to make sure that it checks all those boxes. The other thing it's going to do, perhaps even more importantly, is determine value using comparable market sales. So those comps, as they're often referred to, help us to structure and bracket, okay, here's one that's a little bit higher in value, here's one that's a little bit lower, and how does this guy in the middle, our property, fit into that overall picture? And that is different than a home inspection.
So a home inspection, that's not necessarily required in the continuum of the contract. That's something that's negotiated, at least in our area. So you said that they're going to go out and inspect the property. So a home inspector will go out, they're a licensed home inspector, and they will check like the appliances, and they'll check the roof, and they'll, look in the attic and in the basement, and they'll look everywhere and test all different types of outlets, things like that. Home inspectors do all different types of things, and there's different types of inspections along the way too. But that being said, that's not what an appraiser does?
No, ma'am. So the appraiser, again, it's going to be more concerned with value and general property condition. That, I always refer to the home inspection, it's kind of like a physical for the house that you're getting. It's going to be a top to bottom analysis. You're going to hear everything you want to know, don't want to know in great detail. But I love that because information is power.
That's awesome. So with the different loan types, are there any other inspections that are required? And let me throw a caveat. So in this area in Northern Virginia, we do have houses with land, which have a well and a septic. So is there anything with those types of properties or any properties that there are requirements of any type of loan for certain inspections?
There will, and some of the loan programs will defer to the appraiser to perhaps flag anything that may be related to well and septic. Some programs require it. Some programs such as the VA require termite inspection. So there will be certain inspections required, but the good news is this. As a buyer, you don't have to worry about it if you're working with a realtor and a lender. A lot of that's going to happen on the back end for you.
Absolutely. So, and then with the well, some loans actually require a water test or a water sample,
That's
correct?
True. Absolutely.
Okay. So again, go back and consult your realtor in the area that you are living or looking to buy a property, because they'll help guide you with what's required in that area for the loan type that you're currently working with or looking to work with. We've talked about the continuum of the contract and some of the terminology and the things that have to happen along the way. But I want to go back to the beginning because I do have a question. When someone first calls you and they're asking about interest rates, they have to lock the loan somewhere along the process. And this is a question that we're getting, especially now since rates are a little bit more up and down. So when they're first contacting you as the lender and they want to buy the house with me and you're giving them a rate, what does that mean? And when does that rate actually get locked in? How does that work?
So if it were a Facebook status, it would be, it's complicated.
I like that.
It all depends on your overall plans. If it's new construction, that might be a different conversation than, oh gosh, we're closing in 3 weeks because we need a competitive offer. We do have options that allow you to lock and shop. So because we now know that the rates are going to continue increasing for at least the foreseeable future, 5 to 6 months minimum, you can always seize one of those opportunities to lock that rate once you have an approved application and you're ready to go shopping. That helps to offset some risk associated with the fact that you may not get your first house that you write an offer on. Typically, rates are locked once you're under contract. And what you're doing is you are reserving an interest rate for the term of your loan. If it's a fixed rate loan, I should point that out. So that interest rate is the rate at which you're paying back that money that you're borrowing or buying.
So consult your realtor, consult your lender, consult this video if you want to watch it again for additional information. I'm Ginger Walker, the team lead of Give Back team at Coldwell Banker Elite, and I'm joined by
Jessy Prince of the Prince team at USA Mortgage.